Welcome to week 2 of financial accounting. I'm the only one here at the moment, but I'm hoping others are logging in. I'll go ahead and go over a couple announcements real quickly, and then we'll get into the chapter 2 exercise set and problem set. Hopefully you have already viewed the chapter 2 lecture. Let me show you, just in case you're not familiar. From the course homepage, if you scroll down to chapter 2, there's a study resources link. That is where you will find the chapter video. Got it open in one of these windows here. Here we go. It looks like this. So when you open it up, most weeks there are 2 parts. So to view the entire lecture, watch all the different parts. And that will help you be prepared for what we're going to be going over here in the lab. All right. I also wanted to point out for chapter 2, there's accounting stuff videos that relate to this chapter. So if you open that page in the chapter 2 module, and then you just scroll down to chapter 2, you'll see there's a video about the balance sheet and another video about the income statement. So you might find those useful. Hello, welcome, Natalie. I'm just going over some things for everybody. So now I'm going to cover some announcements. I'll try to post every Sunday and just remind you about what should be wrapped up that weekend and what to expect for the upcoming week. So this last weekend, hopefully you completed the chapter 1 quiz, as well as the DEI quiz for extra credit and the orientation quiz for extra credit. I have graded those. If there's any question on your grade, let me know. There was also the pre-course exam, which is not graded. You'll get a score, but it does not actually count towards your grade. But if you haven't done that, I would encourage you to do that as well. It's basically a mock final that you can take to see what the final exam is going to be like, and then to compare your actual final exam score at the end of the course with your pre-course exam and see how much better you did the second time around. Let's see, I did also give you a link to the chapter 2 readings in the textbook, a link to where you can view the chapter 2 recorded lecture, and a link to our live session that we are in right now. One other thing I'll point out here, actually, you know what? I'm going to do it this way. Going back to the course homepage, there's a labs and orientation page now. Actually, I think it was there all along. Let me go ahead and show that to you. There is a link to the recording of the orientation session. So if you missed that, I would encourage you to watch that. Here is a link to our live sessions every Tuesday. And here are previously recorded labs from a previous semester. You can access the labs from each of these different chapters. However, the labs from this semester, I'll be posting the links here. So later on today, in a couple hours, when I have the recording from this session right now, I will post the link right here, and I'll do that every week. So you can either view, if you miss our live session, you could view the recorded session from this semester, or if you prefer, you can see a recording from a previous semester, which probably won't be quite as thorough as the newer ones, but they're there. So if you are in a hurry and you don't want to wait for the new recording, you could go ahead and watch one of the previous ones. So I hope that makes sense. That's all here on the labs and orientation page. Let's see what else. I had a couple announcements for you. this one, student support resources. There are in Canvas links to a number of student support resources, but in this announcement, I provided this PDF, which you can download. And this PDF gives a nice overview of our different programs that we have available. So I encourage every student to take a few minutes, take a look at these, see if there are any programs that you might qualify for that you didn't know about, because there might be some financial support or other types of assistance that you should be taking advantage of here at Hartnell College. We've got so many of these different programs. It's hard to keep track of them all. And if you find one that you think might be relevant for you, you can click on the link and it will open it up for more details. The other announcement I have for you is about the upcoming Startup Factory event. It's this coming weekend, Friday evening, Saturday, and Sunday. I've decided to give extra credit for students who attend. So you get 1 extra credit point for each day you attend. So if you go Friday evening, 1 extra credit point. If you go on Saturday, that's another extra credit point, and Sunday would be another. All right. There's a link here to register. It is free for Hartnell students. Let me go ahead and show you this 1-minute video. It gives you kind of an overview of what the event is like. This is from a couple years ago. All right, so let's go ahead and watch this.
Here at Startup Week in Monterey Bay, I hope to learn a couple new skills, whether that's web development or web design, or just create a whole team to get my startup going.
What we've been doing this weekend is called Startup Weekend. It's an entire weekend of entrepreneurship, and people came in on Friday night, and about half of them pitched ideas. They've been working all through the weekend to turn those ideas into proposed businesses. And then tonight, they pitched those ideas, and right now the judges are out there deciding what they think the top 2 are.
If I was asked to go ahead and do Startup Weekend again, I would do it in a heartbeat.
All right, so if you are interested, I encourage you to go and attend as much of it as you can. Again, the basic idea is you join a group there. There will be other Hartnell students, Cabrillo students, CSUMB students, but you just join one of the groups. Each group is going to pick a business idea to work on that weekend. So feel free, if you've got your own business idea, you can propose it to the group. Maybe they'll pick yours. And the group will develop a business plan and then actually present it in front of a panel on Sunday, kind of like Shark Tank. So if there are any questions on that, feel free to let me know, but I hope to see you there. I'm going to be there as one of the coaches. And that is it. That is all the announcements I had. If any questions come up, feel free to put them in the chat or just unmute and let me know. But for the rest of our time today, we are going to go through the exercise set and some of the problems. This is actually a hard chapter. I don't know why they started us off with such a hard chapter. I didn't write the textbook or come up with the homework problems. But I guess the good way to look at it is after this chapter, they tend to be easier, I would say. Most of the chapters are easier. Chapter 16 is an exception. That's also a very difficult one. And what's difficult in this chapter is mostly the algebra. So we do have to do some solving for X in this exercise set. And if you don't know how to solve for X, I'm going to show you how to do it, at least the way I do it. You might do it differently. Once you get the hang of that, then this chapter is not so bad, okay? And in this chapter, we learned about financial statements. There are 5 financial statements that we will be making throughout the semester, and we're actually going to make 4 of them this week. They're not that hard. The harder part is sometimes finding the information to put in the financial statements. That could be challenging. And we'll get to that in future chapters. In this chapter, we're learning to make the basic financial statements and what they represent. For example, we'll start here with the income statement. The income statement tells how much revenue the company got from selling its product or service, and the expenses are taken out, and the difference is the net income or the net loss. So the income statement is basically income minus expenses equals net income. Or if your expenses were greater than your revenue, net loss. And so hopefully you already understand that from the chapter readings and the lecture. In this first exercise, what we're going to do is find missing numbers related to the income statement. So each of these rows is like a different income statement. The basic formula, again, is revenue minus expenses equals net income. But you see, we also have here gains and losses. Now, gains are from the sale of an asset. So if a company sells something that is not its product, so let's say they have some old equipment that they don't need anymore, and they sell that. Or they have a vehicle they don't need anymore, so they sell that. If they made money by selling that asset, that's a gain. If they lost money selling that asset, that is a loss on the sale of the asset. Not to be confused with a net loss, which is, did your company lose money overall? And in this formula, we're extending the basic formula. Instead of just revenues minus expenses equals net income, it's revenues minus expenses plus gains minus losses equals net income. All right. And the first one is actually pretty easy. As you can see here, if we just take our calculator, we can say revenues of $1,250 minus, notice the minus sign right here, expenses of $1,100 plus gains of $125 minus losses of $75 leaves us with a net income of $200. And so that is our answer for this first row. Okay. The problem is for the second row, we don't know what revenues is. So this is where we need to solve for X. X is the missing number. Okay, what I'm going to do here is I'm just going to rewrite this formula using these minus signs and plus signs, but using the numbers from this row. Okay, so we have X minus 100,755 plus 0 gains minus losses of 1,550, we know equals negative $485. When you see parentheses in accounting, that's typically a negative number. So if it's in a financial statement and it's around a number, it's negative. If you see a minus sign before a number, that also would be negative. Okay, so now we've simplified our formula down here, well, or rewritten it at least, that the missing number minus 100,755 minus 1,550 is going to equal negative 485. Okay, with this rewritten formula down here, we can now solve it. What we have to do is we have to get rid of everything on this side of the equal sign except for X. Because once we get rid of everything else, then we'll know what X equals. So what we have to do, Sorry, my voice is a little shot. To get rid of minus 100,755, we have to add 100,755. So that wipes it out on that side, but we have to also add it on the other side of the equal sign. Okay, this is what we do to solve for x. Again, to get rid of this minus 1,550, we add it to the left side to get rid of it, and we add it to the right side. Then 0 is 0. You know, we just don't even need it, so we can just take that out. If it's plus 0 or minus 0, just take it out. So we've now simplified our formula. X equals negative 485 plus those other two numbers. And now we can put that into a formula, into a calculator, sorry. Now, anytime you're starting with a negative number, what you want to do is clear out your calculator so that it knows this is not a continuation of the last calculation. This is something new. So now I cleared it out. I can put negative 485 plus 100,755 plus 1,550 equals 101,820. That is our answer. So now we know that x equals 101,820. All right. And what I would encourage you to do, if you haven't already done it, download the template from your exercise set and follow along. If you're not sure how to do that, go to chapter 2, go to exercise set, click on the arrow, not on the link, but on the arrow itself. That'll download this exercise set template. And then if you can just open it up in Word. If you're a Mac user, open it in Pages. You could also open it in Google Docs, whatever works for you. And that way you can take notes on the template as we go along. That will help you later when you have to enter these numbers into Canvas. You'll have the template already filled out. Okay, let me know again if you have any questions. Otherwise, I'm just going to keep going here. And we will solve the third row. Again, I will simplify this. We're going to go 75,560 minus the expenses plus X, because we don't know what the gains are for the third row, minus the losses equals 6,485. So we have to do the same thing. Here is a positive number, so I'm going to subtract it from the left side and subtract it from the right. Here's a negative number, so again, I need to add it to the left side, add it to the right side. Here's another negative number, so I'm going to add it to the left and add it to the right. Now, technically, those weren't negative numbers, it was minus and then the number, but think of it like a negative number. If you see the minus sign and then the number, we're just treating that like it's negative. Okay, so now, again, we know what X is. X equals 6,485 minus 75,560 plus 68,600 plus 1,675. 1,200. X equals 1,200. Oh, and I forgot to show you how we can check, make sure we did it correctly. Once we put in our missing number, then we can just go ahead and do our calculations straight across and see if it comes out right. So 75,560 minus the expenses plus the gains minus the losses equals 6,485. That is the correct number, so we must have done it right. 1,200 must be the correct answer. All right. We have one more solving for X in this exercise. We go revenue minus X plus 320 gains minus 600 losses equals negative 990. Once again, we need to get rid of this. So we're going to subtract it from each side. We'll subtract this 320 from each side. And because this is minus 600, we need to add it to both sides. And then we'll know what x is. Now, in this case, we're actually going to know what negative x is, but that's okay. Don't worry about that. All right. Let's clear this out. And negative 990 minus 26,390 minus 320 plus 600. We get 27,100 negative, right? So this is negative, this is negative. So that washes itself out. Another way to think of it is we already have the negative sign here. So all we have to put for our answer is the 27,100. Let's check it. We'll start with our revenues minus our expenses plus our gains minus our losses. We get negative 990, so we got the right number, right? So this expense calculation is correct. Oh, I take it back. There is one more solving for x we have to do. The final row. So again, I'm going to rewrite the formula down here. And we don't know what the losses are, but this should equal 26,305. All right, once again, subtract this number from both sides. Add this number to both sides. Subtract this number from both sides. And again, we'll see what x is. So we can go 26,305 minus 872,300 plus 856,995 minus 11,000. 0. X equals 0. Okay, let's check it. Oops, I did that wrong. Let's try that again. Okay, 872,300 minus expenses plus gains minus 0 equals 26,305. Good, we got it right. Okay, don't worry, the whole semester is not going to be like this. Again, I don't know why they started us off with such a challenging exercise, but that's how you solve for x. The next two exercises use the same principle, but they're not quite as hard because they have fewer columns. So let's go ahead and move on to exercise number 2. Now, I mentioned that the last one is basically an income statement, right? Revenues, expenses, gains, and losses show up on an income statement, and they tell you how profitable the company is. For this exercise 2, this is from the statement of owner's equity. It says at the beginning of the period, how much equity was there in the company? In other words, what was the value of the company that the investors owned? Well, in this case, it was 0 at the beginning of the period. Then the investors invested this much money. So that's money that went into the company. They took out this much money. Those were distributions that they took out. And this is not to pay a bill. This is money they're taking out for themselves. Okay, so the investors can put money in and they can take money out. And then the ending balance tells us the ending equity, the ending value of the company owned by the investor. In this case, it looks like there's just one owner because it says owner's equity. Well, the first row, again, is pretty easy. We can just go, let's move this around a little bit. Oh, okay. Let's just do that. Or maybe I can make my calculator smaller. There we go. Okay. So for the first one, we're going to take our beginning balance plus our investments minus our distributions, and we get an ending balance of 10,750. Okay, that's pretty easy. For the second row, we don't know the investments. That's X, right? So we'll have to solve for X. So we're going to say beginning balance plus X minus 7,500 equals 66,330. Same thing as before. We're going to subtract this number from the left to get rid of it. Subtract it from the right. We have a minus sign here, so we need to add that number to the left, and we add it to the right. Now we get the calculator again. 66,330 minus 17,630 plus 7,500. So 56,200 is the missing number. And again, we can check it. Start at the left, add the investments, subtract the distributions, and we get the right ending balance, so we know we did put the right number. Okay, beginning balance is X in this scenario, plus investments minus distributions equals 138,900. Subtract this positive number from both sides. Add this negative number to both sides. Okay. Oops, you don't need my calculator. I mean my calendar. I do that a lot. Maybe I'm going to move my calendar over here. I click on it by mistake when I'm trying to get the calculator. Okay, so 138,900 minus 75,300 plus 163,200 is 226,800. That must be our beginning balance here. Let's check that. Add the investments, subtract the distributions. Yes, that came out right. Wonderful. Okay, the next one actually is pretty simple, because here we have a beginning balance of 0. We made these investments. We don't know the distribution, so we can just say what was subtracted from the investments to get this number, right? So investments minus what equals this number? Well, we can just flip it around. And if we say investments minus the ending balance, that'll tell us what the distributions were. So sometimes you can take a little shortcut like that. So investments minus the ending balance tells us our distributions. Too bad they're not all that easy. Let's check that. So we have investments minus these distributions equals correct ending balance. And the last one, we do not have to solve for X because we can just go straight across, add investments, subtract distributions. We get 104,650, and that is the correct answer. All right, so another tough exercise. We got through it. Then let me know if you have questions. Number 3 is even easier because we have only 3 columns to work with. And number 3 relates to the balance sheet. The balance sheet is a financial statement where assets are typically listed on the left, and then liabilities and equity are listed on the right. And if you add up the liabilities and the equity, they should equal the assets. That's what the term balance comes from. They should balance. If they don't, then there's a mistake somewhere in your accounting, because they really should. They should always equal. Your assets should always equal your liabilities plus your equity. Now, there's another way to state the same thing as we see it here. Assets minus liabilities equals equity. That is also true. It might sound contradictory, but let's just imagine for a moment. Let's say our assets were $3. Our liabilities, I'll put them over here, were $1. Well, using this formula, assets minus liabilities equals owner's equity. Assets minus liabilities would equal $2 of owner's equity, right? 3 minus 1 equals 2. But I told you that you can also say assets equals liabilities plus equity. So if we say $3 in assets equals 1 plus 2, that works also. Okay, so the accounting equation, as it's called, can be written a couple different ways. Assets equals liabilities plus equity. Assets minus liabilities equals equity. Or you could flip it around and say assets minus equity equals liabilities. All of those are variations on the accounting equation. And this is important because investors and others who are, stakeholders of an organization, they like to know, how much does the organization own? What are its assets? They also want to know how much debt the organization has and what is the remaining value, right? The equity is what's left over after the company pays off its liabilities. That would be the equity, okay? So let's go ahead and solve this one. The first one's super easy. I don't even need the calculator here. We can just say 32,000 in assets minus the liabilities equals 15,000 in owner's equity. Now here we have assets minus X equals owner's equity. Remember, we could flip that around. So we don't even have to solve for X. We can just say assets minus owner's equity equals liabilities of 22,400. And we can check that. Assets minus liabilities. And that gives us the correct owner's equity. This one is easy again. The third row, we just go assets minus liabilities. Owner's equity is $670. Okay, now this one is different. Here we don't know the assets. Remember down here, I said, if we have $3 of assets, what did I say? $1 of liabilities and $2 of equity, right? So another way we can think about this is owner's equity plus liabilities equals assets, right? That's what I was saying earlier, the way the balance sheet is formatted. You have assets and they're equal to your liabilities plus equity. So if we do that here, if we add our liabilities and our equity, that is our assets. Let's check that. We take our assets minus our liabilities. Oops, yeah, that's right. And yes, that does equal our equity. Okay. Our last one, once again, we can take assets minus equity and figure out the liabilities. $256,900. And we can check that. Always a good idea in accounting to check your work, check your calculations. And yes, that is correct. All right, so 3 difficult exercises. We just got through them. If you are ready, we will move on to something a little easier. Exercise 4 tells us to put an X next to any transactions that would be included in the statement of cash flows. So far I've mentioned the income statement, the statement of owner's equity, which if you're a corporation, you call it statement of stockholders' equity, but it's the same thing. We also have learned about the balance sheet, which is a financial statement. So now we're learning about the cash flow statement. There are only 5 financial statements we'll be focusing on for this whole semester. So we've already learned 3, at least in part, and now we're learning about a 4th one. Now, the cash flow statement is important because if you remember from last week, there's a difference between accrual-based accounting and cash-based accounting. If you do cash-based accounting, then you count a sale when you collect cash from your customer, and you count an expense when you pay your supplier. So that's why it's called cash-based accounting. But most companies don't do that. Only small companies and nonprofits are allowed to use cash accounting. The IRS requires other companies, any medium or large size companies, to use accrual accounting. And accrual accounting gives you a better idea of your profits because you count a sale not when you get paid, but when you provide the product or service. So it separates the cash flow from what's considered a sale. And same thing with your expenses. With the accrual method of accounting, by the way, I know it sounds like I'm saying cruel, but it's accrual. So with the accrual basis of accounting, you count a sale when you provide the product or service, and you count an expense when you incur that expense, even if you haven't paid for it, okay? So that separates the income statement, which tells you how much profit your company is making based on revenue and expenses, sales and expenses. It separates that from your cash flow, right? Because you might have a sale even though you didn't get paid, and you might have an expense even though you didn't pay for it. So the income statement tells you how much profit you made in theory, but the cash flow statement tells you how much actual cash is coming in and going out. And that's why we need both an income statement and a statement of cash flows. By the way, welcome Miguel and welcome Jane, I believe it is. And Natalie was here from the beginning. So others will join us later, perhaps, but if not, they can always watch the recording. And Jane, if you missed, well, you did miss the early part. So once I post the recording, you'll be able to go back and view it and see what you missed. All right. So in exercise number 4, what we're trying to do is figure out which of these 5 transactions would be included in the statement of cash flows. So do they have something to do with cash? Well, the first transaction says we sold some items on account. And what that means is that our customer has an account and they're going to pay us later. In other words, they did not give us any cash, so it's not going to show up on the cash flow statement until they pay us. So we'll just leave that blank. The second one says wrote check to pay utilities. So we got, let's say, an electric bill and we wrote a check to pay for it. Well, in accounting, a check is considered cash, even though it's not what we think of as cash, because that check will get processed probably within a matter of days, and that money will come out of our bank account. We count that like cash. Even if a customer pays us with a credit card, some companies will treat that like it's cash because they know that they'll get that money within a matter of days. Or if they make a payment with credit card, they might count that as cash as well because they know that that money's coming out of their credit card account within a matter of days. Okay, so just keep that in mind that when we talk about the statement of cash flows, that does include checks. So yes, if we write a check, that is going to impact our statement of cash flows. It's money going out. If the investor gives us or the owner of the company gives the company money as an investment, we received cash, right? So that also is going to impact the cash flow statement. Now, the third line says recorded wages owed to employees. So here what it means is it's the end of the payroll period. We figured out how much we owe our hourly workers. It doesn't say that we paid them though, right? Once we pay them, that impacts the statement of cash flows. But at this point, we haven't paid them, so we'll leave that blank. And the last one says we received a bill for advertising. It doesn't say that we paid it, so we will leave that blank as well. So for exercise 4, you just want to X off the second and third rows. Okay, and that's all we have to do. Again, stop me if you have questions. For exercise 5, we need to indicate whether each of these items is current or non-current, and what that means is within a year. So for assets, things that we own, if we are likely to use them up within a year or turn them into cash within a year, then they're current. If we're not likely to turn them into cash within a year or use them, then they are non-current. And with liabilities, if we will pay off that debt within a year, it's current. If it will take us more than a year, it's non-current. So cash is a current asset. I'm going to put C for current, because it's already cash, right? We don't even have to convert it to cash. It is cash. So it could be spent at any time. Inventory is either finished products that we expect to sell, and we would hope to do that within a year, or it's raw materials that we're going to turn into a finished product, and we would also hope to do that within a year. So we're going to put current for both of those. Now, machines typically last longer than a year, right? So those are non-current. Trademarks, that's a way to protect your logo or your product name by registering it with the US Patent and Trade Office, so that if anybody else tries to use your logo or company name or product name, you can sue them and prove that you had registered that. That is an intangible asset. Something that we own that logo, we own that product name, even though you can't touch it. Well, maybe you could touch a printed version of the logo, but the design itself is abstract, right? So you can't touch the design, you could just touch a copy of the design. So even though it's an intangible asset, it is an asset, and it lasts much longer than a year. Trademarks last for decades. So trademarks are non-current, right? Now, accounts payable is a liability. It means that we owe money to our suppliers. So we have accounts with our suppliers where we've purchased things and we need to pay them. Do you think they want to get paid within a year? Yeah, they definitely want to get paid within a year, so that would be current. Same thing with our workers. They want their wages paid within a year, so that is also current. Now, if the owner puts capital into the building, into the company, so they invest money or they invest other long-term assets that they have, they're doing that because they want the company to grow over time and make a profit. So owner's capital is also non-current. They don't like say, oh, I'm going to invest $1,000 and the next month take it back out. That would be unusual. So when they invest in their companies, it's usually for more than a year. And then accounts receivable is the opposite of accounts payable. Accounts receivable means that customers owe us money for things that they purchased from us, and we expect to receive that money. that is also considered an asset. It's something that we own, even though it's really just an IOU. Okay, so let's use an example. A customer makes a purchase and we provide the product or service to them, but they're going to pay us later. So now we have an account receivable. It's like the customer gave us an IOU. They're going to pay us later, and that is an asset. Even though we haven't received the money, we have a promise from the customer that they're going to pay. Once we do receive that money, then that account receivable goes away because now we have it. We would want to receive that money from our customers within a year, right? Definitely within a year, maybe even within a month or two. So that is also current. Okay, these are the correct answers. C for current, N for non-current. If there are no questions, we'll move on to number 6. Here we need to think about how each of these items affects equity. And I said earlier that equity is the value of the company that the owners own, right? If you think back to the accounting equation, you take the assets and then you use some of those assets to pay off the liabilities. What's left over is the equity. So assets minus your liabilities equals your equity. One way to think about it, if you're familiar with how it works with a mortgage, if you buy a house for $1 million and you borrowed $900,000, but you had a down payment of $100,000, okay? So the house, the asset is worth $1 million. Your liability, your debt that you have to repay is $900,000, and your equity is the difference. So you take $1 million asset minus the $900,000 in liabilities, you have $100,000 left over. That is your equity. That's the amount you paid in your down payment. That was your investment. And that is the equity that you have. It's the value of the house after you've paid off the debt. Well, the house is worth more, but it's your portion, right? So if you sold the house for $1 million that you just bought, you have to pay off that $900,000 debt. What's left over is your $100,000. Okay, that is your equity. And in reality, there are sales commissions and fees and things like that, but just to keep it simple, that's the way it works. So now what we need to think about for a company, the equity again is the portion that the owners own, the actual value that they own. We need to think about how do these different items impact the equity? Well, expenses decrease your equity. I'll put D for decrease. The more expenses you have, the less value there is in your company. Assets don't directly impact equity. In some cases, they might. Like if I sell a product to a customer, that sale increases my equity. The revenue from the sale increases equity, and I got payment from the customer, or I got an account receivable, which is also an asset. So in that case, I got an asset and my equity went up, but the equity went up because of the sale, not actually because of the asset. So assets don't always impact equity. I'll give you an example of that. Let's say I bought something for my company and I used debt to make that purchase. So I got an asset that I bought and my liabilities went up to pay for it, but there was no equity involved in that transaction, okay? So assets do not necessarily have a direct impact. So we're gonna put NI for no impact in general. Then we get to gains. Gains are when we sell an asset that's not a product and we make a profit off of that sale. We call that a gain. So again, let's say we have an old piece of machinery we don't need anymore. We sell that, we make money on that. That is a gain. So we are going to put I because that increases our equity. If you remember back to the first exercise, gains increase our net income, they increase our equity as well. Okay, liabilities, like assets, they're not necessarily directly related to equity. So you can have a change in liabilities that doesn't necessarily change your equity. So I'm going to put no impact. And then dividends, that's when the company takes some of its profits and it pays them out to the investors, basically to reward them for being investors. The reason companies do this is that helps attract more investors, and that then pushes up the stock price, because the more people want to buy your stock, the more demand there is, and based on supply and demand, the stock price goes up. So companies will often pay out dividends. They don't always do it, but if they've made a profit, there's a good chance they'll pay out dividends. When they do that, they're taking some of that equity from the company, some of that value, and they're giving it to the investors. So that value is no longer in the company. So the equity goes down, it decreases, and instead goes out to the investors. Okay? I know these are kind of abstract concepts, but the sooner this starts to make sense to you, the easier the rest of the course is going to be. Any questions here on number 6? All right, then we will move on to number 7. We need to figure out the cash balance for this company. All right, the cash balance as of December 31st. Well, here they give us the cash balance at the beginning of December, so that is going to be important. We'll start with that. And we made some sales where we got paid in cash, so those are cash sales. That obviously would increase our cash, right? We paid for some inventory, that would decrease our cash. So I'm going to put a minus sign. We got $3,000 invested by the owners. That's going to increase cash. Here it says we used some supplies. It doesn't say we paid for the supplies, right? So just using supplies does not have an impact on cash. We're going to ignore that line. Cash withdrawals does have an impact on cash because you're withdrawing it out of the company. Inventory received, again, it doesn't say we paid for the inventory, right? So just because we received the inventory, that does not have a direct impact on cash. Paying wages to employees, that does have an impact, and that decreases our cash. So now what I'm going to do, again, I'm going to start here with December 1st. We had $4,250. Then I'm going to go up to the top and add in the cash from the sales, subtract the payments for inventory, add the investment from owners, subtract the cash withdrawals, and subtract the wages paid. So our final cash balance is $6,090. Okay, so we took our beginning cash, added all the cash that came in, subtracted the cash that went out, and that gave us our ending cash balance. Hopefully that makes some sense. Let's move on to number 8. This one is very short. Okay, remember the statement of owner's equity? That was exercise number 2, where we started with the beginning equity plus any investments from the owners minus any distributions that they took out. That's basically what we're doing here on number 8. So the owner, Hudson Alexander, had $175,300 in their capital account. That's the account where you keep track of the owner's equity. If there's one owner. If you've got multiple owners, then they're individual stockholders, and that's treated a little bit differently. Okay, so the owner had that much money at the beginning of the period. Now revenue increases equity because that's sales. Expenses, as we've already said, decreases equity because those expenses reduce the value of your company. So revenue increases the value of your company, expenses decrease. So what we do is we take our starting capital, add the revenue from that period, subtract the expenses, and the result is the ending equity or capital balance of the owner, $171,900. Okay, so all we had to do in this case is we added the revenue, we subtracted the expenses. All right. Number 9, now we're going to make an income statement. This is actually pretty easy. You might remember an introduction to business, at least if you took it with me, there's chapter 14 on accounting. You got to see an income statement there. Sometimes it's called a profit and loss statement, just another name for the same thing. And what it does is, again, it starts with revenue, subtracts the expenses, and gives you your net income or net loss. So here, this company had 2 types of revenue. They had revenue from sales, selling their product or service, and they had revenue from renting out something. So maybe they own a building and they were renting out offices to people. So that generated some revenue. Now, if we add these 2 types of revenue together, we get the total revenue for the month, $77,800. Okay, that's all we have to do for revenue. Now for expenses, we have 4 different types of expenses. Typically, companies have more types of expenses than they have types of revenue. In this case, we've got product and wage expenses. Let's go ahead and put those in. And we also have utilities and tax expenses. Notice they put here owner investment. That is not something that shows up on the income statement. We're only looking at the revenue and the expenses. So we're going to ignore owner investment. Equipment purchases, that also does not show up on the income statement. It seems like that would be an expense, but with big items like that, long-term assets that are going to last multiple years, we don't take the expense all at once. We have to depreciate it over a number of years. So we are just going to ignore this equipment purchases. And since we just bought it, we're not even going to take depreciation yet. We'll do that at the end of the year. So just ignore owner investment and equipment purchases. But now that we've listed our 4 different expense types, we need to total those up. I got 73,300. Okay, I made a mistake. I think that was supposed to be 77,800. Yeah, it was. Okay, so we have our total revenue, which is these 2 combined. And then we totaled up our expenses to get total expenses. And now we take revenue minus expenses, and that gives us net income. Which in this case is $4,500. Okay, so the company made a profit or net income of $4,500. So that's not too bad. That's the way income statements are formatted. Revenue minus expenses equals net income. Or if your expenses were greater than your revenues, then you have a net loss. All right, I'm going to move this down here and we will move on to number 10. We're making pretty good progress here. We have only this and one more exercise, I believe. Yes. And we are going to go through, there are 6 problems. We're going to go through part of each of the 6 problems, and then we'll be done. Okay, in this one, we are making the statement of owner's equity. So again, we start with how much equity the owner has. So we'll put Pirate Pete's capital at the beginning of the month is $56,000. Then we're going to put anything that increases his equity or capital. Well, he invested $1,500. That increases the value of the company. So we're going to put that under increases owner investments. And that was really the only thing that increased equity. So now we're going to total that up. The total increases is $1,500. We will later add that to the beginning capital. But first, let's look at any decreases. So we see that the company lost money. It lost $7,800. That is going to decrease the equity or value of the firm. Also, Pirate Pete took out $100 of owner withdrawals. So we're going to add up these 2 decreases. That's a total of $7,900 that were taken out of the company, either by losing money or by the owner taking it out. Let me point out supplies expense we didn't need because expenses go on the income statement, right? The statement of owner's equity does not include that. So sometimes the authors of the textbook threw in additional information to confuse us. We also did not need cash. Cash would go on the cash flow statement. It would also go on the balance sheet, but it does not go on the statement of owner's equity. Okay, so now we've got beginning capital or equity of $56,000 plus the increases minus the decreases, and that will give us our ending capital. So $49,600 is Pirate Pete's ending capital. In other words, that's how much equity he has in the company at the end of the period. Let me check and make sure I calculated that correctly. Let's see. We are up to number 10. And it was, yes, 49,600. Very good. And we have one more exercise, and then we'll move on to the problem set. In this one, we are going to make a balance sheet. And remember, the balance sheet is based on the accounting equation, assets equals liabilities plus equity. We can see here assets, and over here, liabilities and equity. Okay. And here is the data we're going to use to fill this in. Let's see if I can fit this all on one page. There we go. All right. So assets, we have 3 assets in this company. We have cash. We have inventory. And we have equipment. All right, so we can add those up and we will have our total assets. $26,580. Welcome, Omar. We are at the very end of the exercise set, but we are going to take a look at the problem set as well. And once I post the recording later today, you'll be able to go back and see what you missed from the exercise set. Okay, so that was easy. That's our total assets. Now let's go to the other side, liabilities. Anytime you see the word payable, that's a liability because that means we need to pay somebody. So we have a debt and that is a liability. Accounts payable is 1,730. Now notice here we've got two columns. That's just because we're going to be subtotaling. Wages payable is 2,150. Let's go ahead and add those together. That equals 3,880. That is our total liabilities. Let's see. Now here, notice there is Ginger Ales. I guess that is the owner's name. Ginger's capital as of March 1st. And here is Ginger's capital as of March 31st. Well, the balance sheet is as of March 31st. So we want the ending capital. Okay. And that is the only thing that goes in the equity section in this particular example. What did I want to tell you? There was something that crossed my mind. Well, I did.
I have a question.
Oh, okay, go ahead.
The product expenses, does it go into liabilities? It is an expense.
Good question. Yeah. So product expenses would not go on the balance sheet. They would go on the income statement.
Oh, okay.
But not here. So an expense is not necessarily a liability, right? Because like, let's say you purchase something that you're going to use in your business. That's an expense. If you paid for it, it's not a liability. If you didn't pay for it and you have to pay for it later, then it is a liability. So an expense might be a liability, it might not. Expenses do decrease equity, but that already would have been calculated into this ending number. So we do not need to include expenses on the balance sheet. Good question. That was one of the things I wanted to share with you. Let's see, are there any other accounts here that we don't need? We don't need the capital as of March 1st, because again, the balance sheet is as of March 31st. And yes, that's what it was. The balance sheet is always as of one particular day. The other 4 financial statements we'll be making during the semester are for a period of time. So they might be for a month or a quarter or a year. The balance sheet is as of a particular day. How much in assets do we have? In other words, what's the total value of everything we own? How much in liabilities do we have? In other words, how much do we owe? And the difference is the equity. Okay, so now if we add our total liabilities to the only equity, we should get the exact same number that we have on the assets side. So let's go ahead and add the equity. And yes, we get 26,580. Whatever. Okay, so our assets equal our liabilities plus equity, and we now have a completed balance sheet. It balances, right, because they equal each other. And this is one of the primary financial statements. Okay, so we've gone through the entire exercise set for chapter 2. Any additional questions on this exercise set? I do want to show you, in case you're not already aware, how you're going to now get credit, because you do not turn in this exercise set template. It's just for you. So the way you're going to get credit for it is by Saturday. I'm just going to switch to student view so you can see the same thing that, that you'll see when you go in. On Saturday, you're going to go to, or by Saturday evening, okay, anytime between now and then, go to the chapter 2 module, go to ES2, exercise set for chapter 2, and you're going to click on this take the quiz button. I guess I already took it once, so it's asking me if I want to take it again. You are allowed 2 attempts on every exercise set, problem set, and chapter quiz. And it automatically gives you the higher score of your 2 attempts. So when you click on this, it's going to give you 10 questions based on that exercise set. Now, you only have 20 minutes to put in your answers. So that's why you want to have your template already filled out before you start this quiz in Canvas. And here's an example. It says exercise 4, don't pay attention to the A. The E is for exercise, and it's number 4. So exercise 4, the rote check to pay utilities amount will impact the statement of cash flows. Well, if you don't remember, you go back to your template, go to exercise number 4. Sometimes you could just do a search for EA4 and it takes you right there. Rote check to pay utilities. We said, yes, that does impact the cash flow statement, right? So now we can go back here and answer that true. It will impact the statement of cash flows. The next question says exercise number 1, row 4 expenses. Okay, let's go back. Let's go to exercise number 1 up at the top. This is the 4th row, and it asked for expenses, right? So let's see, will it let me copy and paste? I actually know the answer. I was able to paste, but it doesn't like the $, so I have to take that out, okay? If I typed it in, if I didn't put the comma, it will add the comma automatically. If your answer is less than a whole number, you can put point, whatever it is. You cannot put the percentage sign. So if your answer to a question was 20%, you can't put percent. So if you just put 20, that's going to be wrong. You would have to put 0.2, right? Because 0.2 is equal to 20%. So keep that in mind, but that's basically what you're going to do here. You're going to put in your answers, submit it, see what score you get. And again, if you don't like your score, you can take it again and automatically you get the higher score. The problem sets work the same way. You also have 20 minutes, so make sure you've got your problem set template filled out before you take it. All right, any questions on the process for getting credit for the exercise sets? Okay, all right, well, let's go ahead and do the problem set. And we will be done on time, maybe even a little bit early. Okay, so I've opened up the problem set template. Again, you can go to PS2 in the chapter 2 module of Canvas, and you can look for that little download arrow and you can download, download the problem set as a Word document and then open it up in any program that can read a Word document. So this first problem is, again, related to income statements. It gives us data for the revenues, expenses, gains, and losses for a company for 3 different months, January, February, and March. So you're going to do parts A and B on your own. I'm going to go through part C with you right now because it's a little bit more difficult. And I'll also show you how to do part D, okay? So for part C, we're dealing with March. The first thing we need is our revenues minus expenses. So we look up here, we see March revenues and expenses. We're going to go revenues of 42,800 minus expenses of 45,100. And we get a negative number, negative 2,300. So that means for that month, the company's expenses were more than its revenues, so it actually lost money from its operations of selling its product or service. However, when a company sells assets that are not its product, sometimes it makes money from that, or sometimes it loses money from that as well, right? You can have gains and losses from the sale of an asset. So in this case, for March, we had gains of $5,600 from selling assets, minus losses of $3,700. So that's a net gain of $1,900. That's what we're going to put here under gains minus losses. Then we're going to add those two numbers together. So we're going to take negative 2,300 plus 1,900 equals negative 400. So we lost $2,300 from selling our product or service. We made $1,900 from selling other assets. The net impact combined is a loss of $400. Okay? So you could either say there was a $400 loss, or you could say the net income was negative $400. You could look at it either way. That's part C. Any questions on how we got those numbers for part C? For part D, we need to comment on the firm's performance. So the easiest way to do this is just think about, did the company make money from its main operations? And did it make money by selling other assets? And we're going to say in this case, the company lost money from its operations, but had a gain from selling other assets. Okay, you can use that same format when you do part D for A and for B. Just say, did they make money or lose money from their operations, which is the first column, and then did they make money or lose money from selling other assets? And that will be sufficient. Then when you take the problem set quiz in Canvas, which is due Sunday, you don't know what question's going to come up related to this problem. So you'll be able to look at this and quickly have the answers for the problem set. All right. Are we ready to move on to problem number 2? Okay, so here, this is a little different. Here we've got 3 companies, company 1, company 2, company 3. All right, and again, this is owner's equity. We're saying beginning equity plus net income. That's money that the company made from operations and selling assets. Or if the company lost money, then we would be subtracting that. Then adding any investments that the company has and subtracting any money that the owners took out. Welcome, Maria. We have completed the exercise set. We are now in the problem set, and you'll be able to watch the recording later to see what you're missing. Right? There is some background noise, so if you would just stay muted unless you have something to say, that'll be helpful. Okay, perfect. All right. Okay, so I'm gonna do with you company 2, I believe. Let me double check my notes. Yes, we are doing company 2. All right, and then you'll do companies 1 and 3. Now, what we see here is a missing number. We're gonna have to solve for X. So let's just go ahead and I'm gonna use this as a scratch pad. For those who weren't here earlier, we did a lot of this at the beginning of the exercise set. Or if you're familiar with algebra, you might know how to do this already. So what we're gonna do is we're gonna take this information, I'm gonna retype it down here. And then we're gonna solve it. And figure out what X is. Okay, so the beginning balance plus net income of 0 minus the net loss of $12,000 plus 0 investments minus whatever distributions is equals 44,880. So we don't need the zeros. Anytime you add 0 or subtract 0, it doesn't change anything, right? So we're just going to go ahead and take that out of the equation to simplify things. And then to know what X is, we have to get rid of these other numbers that are on the same side of the equal sign. And the way we do that, this one is a positive number. We're going to subtract it from the left side. So if we subtract 63,180, that goes away. But we have to also subtract that number on the other side of the equal sign. And this, we have minus 12,000, so we need to add that to the left side. And again, we have to add it to the right side. Now we can figure out what X equals. We take 44,880 minus 63,180 plus 12,000 negative 6,300. But notice here, it also says negative, right? So really, the easier way to think about it, X in this case just equals 6,300. When you calculate your answer here, even if it comes out as a negative number, well, it won't in this one. It'll be a positive. Actually, both of these will come out as positive numbers. So you'll be fine. But just so you understand what I'm talking about, when we did this calculation here, we came up with negative 6,300. The negative X equals negative 6,300. Well, if you know from algebra, you could take negative off of each side and say X equals 6,300. Okay? So you're going to solve company 1 and company 2. And the other thing we need to do here is observations. So let's just go ahead and do company 2's observation together. If we look at what happened, we see the company started with equity. There was value in the company, but then it lost money, right? It had a net loss. And the owners took money out, right? A distribution is when the owners take money out. So we could say the company lost money, or a better way to say it, the company had a net loss and the owners took out distributions. All I'm doing is just summarizing what happened here. And that's why they went from $63,000 of equity down to about $45,000 of equity, because they lost money and the owners took money out. So after you solve company 1 and company 3, go ahead and type your observations. For example, we can already see company 1 had a net income, right? They made money from their operations and the investors put in more money than they took out. It looks like company 3 is going to have a net income as well, but you'll have to figure out what that is. And they did not invest any more money, but they did take distributions. Okay. So again, let me know if you have any questions. You can unmute or you can put something in chat. But otherwise, we'll go on to problem 3. I'm going to go through years 1 and 2 and let you do year 3 on your own. Here we have assets, liabilities, and equity. Again, that is the accounting equation. And it's also what we see on the balance sheet. So this company's been around 3 years, and we see that in the first year, or at the end of the first year, they had $245,000 worth of assets. They had $120,000 worth of liabilities, which are debts. And so the difference is the value of the company or the owner's equity. So we are supposed to comment on changes in the accounts and possible sources and uses of funds. Okay. Well, we don't know where these assets came from. Probably $125,000 of them came from the owners investing money into the company, right? Because that's their equity, but we don't know for sure. Maybe they invested $100,000 and the company had $25,000 of profit. That would then cause their assets to go up and it would cause their equity to go up. So we don't know for sure, but we can say the assets came from owner investments and or profits. Okay. Actually, liabilities are there too, right? That means the company incurred some debt. They must have gotten that debt in order to acquire some assets. So let's add that in. Assets came from liabilities as well as owner investments and or profits. Okay, we know for sure that they have some liabilities, and that explains some of the assets, right? Like a company borrowed money so they could buy a tractor, right? So now they have a liability and they have an asset. But they have way more assets than they have liabilities. So where did the rest of the money come from? It could have come from investment by the investors that put money in, or it could be profits of the company where they made some money and they used that. Either they just left it in the bank, that would be assets, or they used it to buy other assets. Okay, so we can infer that just from looking at these numbers. Now, if we compare year 2 with year 1, we see the assets went up, right? By, what is that, $41,000, right? So the assets went up by $41,000. The liabilities went up by $30,000. So they increased their debt. Again, that probably funded some of the assets that they acquired. We also see that equity went up. That could again be owners putting more money in, or it could be profits of the company. So here we could say assets increased from liabilities, and really it's the same thing. The rest of it is either from owner investments or profits or both. Okay? I know it's a little confusing because we don't have a lot of detail here, but just looking at the numbers, we can infer some of what's going on. Now for year 3, what you're going to notice is the assets went down quite a bit, and so did the liabilities. The equity only went down a little bit. So think about that. What would have caused the liabilities or the debt to go down and the assets to go down? One way to think about that, if we think about our personal lives, let's say you've got debt, maybe you've got a student loan. If your student loan goes down, how did that happen? Well, maybe the student loan forgiveness finally came through and reduced your student loan. But other than that, what else could cause your debt to go down? And your answer to that is the same answer here. Okay? So give that some thought and then go ahead and just explain what you think happened in year 3. Are there any questions on that problem? All right, well, we will go on to problem 4. Here's another one where we're dealing with income statement information. We are going to do company B together. Now, before we saw horizontally revenue minus expenses plus gains minus losses, right? Well, here it's the same thing, it's just vertical. So remember, it's revenue minus expenses plus gains minus losses. That gives you your net income, okay? And we're going to do B together, which means that we need to figure out what is the expense here. So let me give myself a little room to work. We're going to do it the same way. We're going to solve for X. So we're going to say revenue minus X, because we don't know what the expenses are, plus the gains minus the losses equals negative 9,250. Right? And we're going to solve this the same way. We'll subtract this positive number from both sides. We'll subtract this positive number from both sides. And this negative number here, we have to add it to both sides. Okay, that washes it out on the left. So all we have left is X. Now we can do our calculations. When you start with the negative number, be sure to clear out your calculator. So negative 9,250 minus 167,320 minus 1,350 plus 6,240 equals negative 171,680. Now remember, in algebra, you can take out the negative on both sides of the equal sign. So we know X equals 171,680. That is our expenses. All right, so you're gonna do that for companies A, C, and D. You'll find the missing numbers. We can check our calculations. If we take our revenues for company B minus our expenses plus our gains minus our losses, we should get negative 9,250. We do, so that means we did it right. Now, profit margin is included here. You don't need to do any calculations with that, but I will go ahead and explain it to you real quickly so you know what it is. Your profit margin is your profit, or in this case, a loss, because it's a negative number, divided by your revenue. So if we take our negative 9,250 divided by our revenue, we see if we round that up, it's negative 6%. So we have a negative 6% profit margin. What that means is the money that we lost is equal to 6% of our revenues. So you can see for company C has a positive profit margin, so they made a profit, and their profit is equal to 6% of whatever the revenues are. Company D, their profit is 3% of their revenues. And with company A, their profit is 24% of the revenue. So you don't have to know that for this particular exercise, but it is useful. And if you're comparing the 4 companies, which of these 4 companies would you invest in? Would you invest in one that has a 24% profit margin? In general, that's pretty good. Or would you invest in one that has a negative profit margin that's losing money? Probably not, right? Okay, so the other thing you're going to do once you have found the missing numbers here is you need to explain how would stakeholders, anybody who has a stake in the company, whether it's financial or not, so that includes investors, creditors, suppliers, employees, the public, the local community, how do all these different stakeholder groups view the financial performance of each company? Well, for company B, again, their expenses were more than their revenues. So we can say the company lost money from its operations, and their losses on the sale of assets were more than their gains on the sale of assets. So the company lost money from its operations and from the sale of assets. Okay, so you can use that format just like we did in the, was it the first problem? Yeah, right? We looked at how did they do from revenue minus expenses, that's their operations. How did they do from gains minus losses? That's the sale of assets. So you can use that same format here. Sorry, I'm jumping all over the place. To answer A, C, and D, okay, for part B. So that's what you're going to do there. All right, we've got a couple more problems to do here. 6. Oh, we have 8 problems. We have 4 more problems to do. Ooh, I better get moving here. I was thinking there were only 6, but there are 8. Okay. All right, hold on. We're going to go through these other ones a little faster. For each of the following independent transactions, indicate whether there's an increase, decrease, or no impact for these 3 categories: assets, liabilities, and equity. All right. If a company pays cash for expenses, when you pay cash, that decreases your assets. There's no impact on liabilities because it doesn't say anything about debt, right? We have an expense, but it's not necessarily a liability. So there's no impact on liabilities. And remember that expenses decrease equity, right? So here's our answer here. For this first one, it decreases assets and it decreases owner's equity, no impact on liabilities. Now, think about the accounting equation. Assets equals liabilities plus equity. In this case, when we paid cash for expenses, paying cash decreased our assets. The expenses decreased our equity, right? So both sides of the accounting equation went down. Assets went down, and either liabilities or equity went down. In this case, it was equity. So we're still in balance. Let's say assets went up and either liabilities or equity went up, then we are still in balance. In some cases, you might have a liability go up and equity go down, or equity goes up and liability goes down, but they wash each other out and they still equal the assets. So then we're still in balance. So it's kind of cool how it works. These Financial impacts always impact both sides of the accounting equation, but always leave it in balance. So let's see, which of these was I going to cover with you? I was going to cover, are we on 5? Yes, I was going to do 1 and 2. Okay, so number 2 says we sold common stock for cash. We sold some common stock for cash. We got cash from the investor. So assets, cash increases. And owner's equity increases because we then issue stock to the customer. Stock is equity, and so it has increased. Liabilities, again, did not change. All right. The last 3 you're going to do on your own. So I know it's a little difficult, but you really have to think through what are the 2 parts of this transaction. What went up or down and what else went up or down, okay? And then the other thing is no impact. So if you get stuck on this one, feel free to email me and I can help you, but try to solve that on your own. Let's move on to number 6. This one's a little weird as well. Okay, so this is an apple orchard and they just finished their first month of business. What we need to do is figure out with each of these transactions over here, how did that impact assets, liabilities, and equity? Now, the first one is done for us. They purchased some land using debt. So land is an asset. It's something that we own. So that went up by $50,000. But because we use debt to finance it, we now have a $50,000 liability, and there's no impact on equity. Okay. The next transaction, we sold some apples for cash. So we got cash, $3,000. So that is an increase to our assets. We also made sales, right? We sold those. Remember that revenue, which is our sales, increases equity. So the value of our company increases because of those sales. No change to liabilities. Okay? I'm going to let you do Apple sales credit. One thing I will tell you, if you make a sale on credit, what that means is the customer is going to pay you later. Technically, that gives you an account receivable, but that is still considered an asset. So even though we didn't receive cash, the fact that they're going to give us cash in the future, we still consider an asset. Okay, that's your little hint. We'll do the next 2 rows together. Collections of credit sales. Okay, what that means is that in a previous period, we sold to a customer. Well, now, how is that possible? Didn't it say this was our first month? That's weird. Okay, we'll just go with it. Maybe earlier in the month, we made a sale and the customer did not pay us at that time, but now they're paying us. When that happens, their account receivable goes down and we get the cash, so cash goes up. So they paid off their account receivable, which for us was an asset. It was like an IOU that we were holding on to. So that accounts receivable is an asset that goes down. The cash we receive is an asset that goes up. So that washes itself out and has a net impact of 0. So on this one, there was 0 net change to assets and also no change to liabilities or equity. Confusing, I know, but that's the way it works. And that's because the sale was previously counted when we first made the sale, but now the customer is just paying what they already owed us, right? Okay, the next one, cash purchase of equipment. We bought $10,000 of equipment. That's an asset going up, but we paid for it with cash. That's an asset going down. So again, we have an asset going up, an asset going down, washes itself out. no change to liabilities or equity. Okay? Do your best to go ahead and fill in the rest of this. Here's a helpful thing. Once you finish the column, you add up all the numbers. Your assets should equal this, your liability should equal this, and your equity should equal that. And if you notice, liabilities plus equity equals our assets. Okay? So give that a shot. And now we'll do 7 and 8. Good, we just barely have enough time. I thought I was going to be early today, but I misjudged. I forgot that we have 8 problems. Okay, on this one, we have to refer back to problem 6, and we have to figure out what's the total revenue and what are the total expenses. And the way we do that is actually pretty easy. In this company's case, their revenue is their sales, right? Revenue is the money from sales. They sold $3,000 of apples for cash. They sold another $6,000 of apples where the customer is going to pay later. So that's a total of $9,000 of revenue. Okay, so that's the answer, $9,000. Now with expenses, there are 3 expenses listed here. The equipment that was purchased is a capital asset, so we don't consider that an expense. But we did have wage expense, fuel expense, and utility expense. We add those together, and we get $7,400. Okay? That is the total of these 3 expenses. So that's all you have to do. That's the answer for problem 7. And we get to our final problem. Now, this one has multiple parts. The first part, we've got this list of transactions. Okay, this is also a brand new company. And in the first month, this is in the month of July, we see 10 transactions. Now, they didn't tell us what those transactions are, but what they did show is the first transaction, cash, went up by 50,000, and common stock went up by 50,000. So that must mean an investor gave us $50,000 and we gave them common stock. The second transaction, okay, we see cash going down 6,000 and inventory going up. So it looks like we bought some inventory for cash. So by looking closely, we can kind of figure out what's going on. What we need to do, the first thing, is we need to add up each column. So let's go ahead and do that with cash. We have 50,000 positive minus 6,000 plus 1,250 minus 750 plus 3,200 and minus 1,000. Okay, so if I did that right, we have $46,700 cash at the end of the month. Inventory, there was only one, so that's $6,000. Equipment, there were 2. We could add those together. We get $23,000. Accounts payable adds up to $22,775. Wages is $3,000. Common stock is $50,000 total. And retained earnings, we haven't really talked about that too much, but that is the profits that we have not spent. So when a company makes new profits, that increases retained earnings. When they have a loss or they pay out dividends, that decreases retained earnings. But let's just go ahead and add up these retained earnings. So we have 1,250 minus 750 minus 600 minus 3,000 plus 3,200 minus 175. Okay, and we end up with negative $75 for retained earnings. Okay, one last thing we could do here for part A is if we add up our 3 types of assets, cash, inventory, and equipment, they should equal these total assets here. Let's double check. Oops, I did that wrong. Let's try that again. I missed 1 0. 46,700 plus 6,000 plus 23,000 equals 75,700. Good. And if we add up our liabilities and our equity, that should also equal 75,700. So we take liabilities plus equity minus that 75 negative equity. And yes, we get 75,700. So it looks like our totals are correct here. That's part A. Part B, we need to create the income statement. Okay, well, we know that we take revenues minus expenses equals net loss. The problem is we don't know what are revenues and what are expenses. So in this particular exercise or problem, every place we see retained earnings going up, it's because we made a sale, and so it's revenue. Okay, so just trust me on that one. So let's add together every place where revenue went up, 1,250 plus 3,200. So basically we had 2 sales and they totaled $4,450. That is our revenue. Expenses are where we see retained earnings going down. So we had 750, 600, 3,000, and 175. So we had $4,525 of expenses. Now, if you remember, the income statement is revenue minus expenses, right? So let's do that. Revenue minus expenses is a loss of $75, okay? So I'm just gonna go ahead and, oops. Sometimes we use minus signs to show negative. Sometimes in accounting statements, you just need to know what's negative. So for example, we know that revenues minus expenses equals a $75 loss, right? So that's one way to write it. If this said net income, then I would put the minus sign to show the income was negative. It doesn't really matter, as long as we know that we lost 75 bucks, okay? Part C, we need to do our statement of owner's equity, or stockholders' equity in this case. So at the beginning of the period, there was 0 equity, right? It's a brand new company, didn't have anything, any assets, any liabilities, any equity. Started with 0, and then the investors invested $50,000, right? So that increases equity. Then we had a $75 loss, right? Remember our retained earnings was negative $75. Another way to say that is our loss was $75. So we have to subtract that, and our ending stockholders' equity is $49,925. Okay, so we started with 0. We added $50,000 of common stock. We have to subtract the $75 loss, and that gets us an ending equity of $49,925. So the company's worth a little bit less than it was after the first investment. Then we go on to part D, and this is our balance sheet. Let me try to fit this all on one page here. Okay, so for the balance sheet, first we need our assets, right? If we go back up to part A, we saw cash was 46,700. Inventory was 6,000. Equipment was 23,000, right? So let's go ahead and put that in. We already know what those equal. Let's just double check. So 75,700 was the total assets we saw under Part A. And that is also the total assets here. Okay, so that's pretty easy. On the other side, we need to put our liabilities. So we had accounts payable and wages payable. Let's go back up here. Accounts payable is 22,775 and wages payable is 3,000. We'll add those together. Okay. Common stock, remember we issued $50,000 of common stock. And remember our retained earnings was negative $75. And together that equals the common stock minus the retained earnings is the same 49,925 that we saw on the statement of stockholders' equity right here, right? $50,000 of common stock minus the $75 retained earnings loss gets us 49,925. Now, if we take our liabilities plus our equity, we should get 75,700. 75,700. So our balance sheet is in balance. Our assets equal our liabilities plus equity. And we have a few minutes to spare. All right. So what questions do you have before we sign off? Anything need clarification? Anything you didn't quite catch? No? All right, sounds like everybody's good. So that's it. Again, if you need to go back and see part of this, sorry, I clicked on the wrong thing. You need to see part of this lab. What you're gonna do, go to the home page. The very second module is where you're gonna find it. So labs and orientation. As soon as I get the recording link this evening, I'm going to paste it right here under chapter 2's recording. Next week, it'll go here for chapter 3 and so on. All right. And you also have recorded labs from previous semesters as well. All right, that's it. So we're done. Feel free to email me if any questions come up. Otherwise, have a great week. And if you go to this Startup Factory, I will see you there. All right, bye-bye.